Here's the line you've probably heard if you spent any time around Dave Ramsey talking about whole life insurance. When you die, the insurance company keeps your cash value. Your family only gets the death benefit. And here's the thing that's true, that's exactly how it works. But here's the thing nobody ever points out. The exact same thing is true about the house you're living in right now. And you've never once been mad about it. Not one time have you sat there thinking about your home equity and felt cheated. So, why does this make people furious in a life insurance policy, but not in a house? I design these policies for a living, and this is the objection I hear more than any other one, hands down. And it falls apart completely the second you see where the money's actually sitting. By the end of this video, you'll understand why they keep your cash value in this misunderstood sentence in insurance, why it's the same math as selling your house, and how to check your own policy for it in 5 minutes. Okay, so let's talk about the picture in your head because I think this is where the whole thing goes sideways. Most people imagine whole life insurance as two separate buckets sitting next to each other. Bucket one is the cash value, bucket two is the death benefit. You spend decades filling up bucket one, paying premiums, watching that cash value climb, and then you die and the insurance company just keeps it. Your family only gets handed bucket two. And look, if that's actually how it worked, you'd be right not to be angry. That's not a misunderstanding, that's theft. You're not crazy for being suspicious of that setup because that's really what's happening. Somebody should be furious. So where does this two bucket picture even come from? Usually it's one of three places. Sometimes it's an agent who sold the policy and either didn't understand it themselves or just never bothered explaining it clearly. Sometimes it's one of those Reddit threads where someone's doing the math on a policy they don't own based on numbers they don't fully understand. And sometimes, honestly, it's just your own parent who bought a whole life policy 40 years ago and never got a clear explanation and has been grumbling about it every Thanksgiving since. Here's what all three of these have in common. Nobody ever sat down and showed the one thing that actually makes this click. Not the sales pitch, not the Reddit post, not your dad's complaints. So let's fix that right now, and we're gonna use the most expensive thing you'll ever own to do it. Picture your house. Let's say it's worth $500,000 today, and over the years, you've built up $150,000 in equity. Now walk through what happens when you sell it. You don't get the $500,000 value and the $150,000 equity handed to you separately like two checks stapled together. You get the $500,000, period. Because the equity was never sitting off to the side in its own account, it was living inside the value the entire time. And here's the part that matters. You've never felt robbed by this. Nobody sells a house and says, wait, where's my equity? I thought I was getting that too on top of the sales price. That would be a ridiculous thing to say because they already understand instinctively that equity is part of the value, not separate from it. Now set your policy right next to the house. Cash value is the equity, death benefit is the value. When you pass away, your family gets the death benefit and the cash value was inside that number the whole time. It was never sitting in a second account waiting to get handed over on top. And here's the structural fact that makes this airtight. At least for the kind of policy we're talking about on a properly designed whole life policy from a mutual carrier, the one built with base premiums, funding a paid up addition structure, the death benefit is always bigger than the cash value. Every single year of the policy all the way through. Technically, those numbers do meet at age 121. That's called the policy maturing or endowing. And at that point, the company just pays the full benefit to you while you're still alive. So in practice, for every real policy on a real person, the death benefit stays bigger than the cash value for the entire time you're alive to see it. This isn't true of every policy with the words whole life on it. By the way, final expense policies and some other stripped down whole life products don't work this way. So what I'm describing here is the specific to be properly built version, not the whole category. But for the policy we're breaking down, which is the one you should actually want, you're never trading a number for something smaller, you're trading it for the bigger number it was building toward the entire time. Now, let's stop talking in generalities and put real numbers on the table. A real mortgage next to a real policy so you can see exactly how this plays out. Let's put actual numbers on the table because this is where it stops being a theory and starts being math you can check yourself. Let's say you buy a $500,000 house with a 20% down payment. That's $100,000 out of pocket. That's a $400,000 mortgage, 30 years, 6% 4% interest, and you're paying around $2,400 a month. Run that for the full 30 years, you've paid $863,000 in total just to own that house outright. Now, here's the policy right next to it. $400,000 death benefit, same number as the mortgage, funded at $427 a month, and you pay into it for 30 years until it's paid up. Same finish line as the mortgage, same 30-year runway. So how does a policy actually grow? Your premium covers the cost of insurance, basically what it costs the insurance company to keep you covered that year. Whatever's left over goes to work. In a mutual company, it shows up as a dividend. The dividend buys something called paid up additions. Those are permanent little chunks of death benefit and extra cash value, and they stack on every year you own the policy. That's the engine. It's not complicated. It's compounding quietly in the background year after year. So what does 30 years of that look like? By year 30, the death benefit has grown from $400,000 to $575,000. Cash value sits at $240,874, and you've paid in $153,000 total over those 3 decades. Look at the shape of both of these things. With the house, you paid $863,000 total just to end up owning something you bought for $500,000. With the policy, you paid $153,000 total to end up with $575,000 in death benefit and $240,000 in cash value you can actually touch while you're still alive. Same idea in both cases. You're putting money in over time to build something bigger than what you paid. But look at how differently those numbers land. Now, let's be honest about both sides, because I'm not here to tell you one of these is magic and the other one's garbage. Home appreciation isn't guaranteed. Dividends on a policy aren't guaranteed either. Both of them can run hotter or colder than projected. But here's where they split. The policy has a $400,000 death benefit floor written into the contract, guaranteed. The house has no floor at all, and you're on the hook for that full $863,000 in payments no matter what the house ends up being worth when it's all said and done. Now, somebody watching this is thinking, fine, my family gets the bigger number. I get that now, but I'm dead when that happens. So what good is all of this cash value while I'm still alive and breathing? It's a fair question, and the house answers it again. You don't have to die to touch your home equity. You take out a HELOC, a home equity line of credit, and you keep living in the house the entire time you're using that money. The policy does the exact same thing, except better. You can borrow against your cash value while you're alive for whatever you want. A car, funding a business, income in retirement, it doesn't matter what it's for. The cash value is sitting there and you can access it. Here's where it beats a HELOC outright. When you borrow against your cash value, that cash value never actually leaves the policy. It keeps earning, keeps growing. The whole time you're out there using borrowed money against it. No application, no credit check, no bank sitting on the other side deciding whether they'll approve this month. Compare that to a HELOC where a bank can freeze your line, change your rate, or just say no. And the loop closes exactly the same way you'd expect. When you pass away, your family gets the death benefit minus whatever loan balance is still standing. Same as to your heirs getting your house value minus whatever's left on the HELOC. Nothing hidden, nothing different from how debt against an asset actually works. So here's the actual reason people buy these policies. And it's not about betting on when you're going to die. It's about having a pile of money that's safe, that grows with a tax advantage, and that you can reach the entire time you're alive and use it. The death benefit is the backstop. The cash value is the tool you actually use every day you're breathing. Now, here's one honest catch in all of this. Year one is a loss. Even with a policy designed as well as it can be, you're looking at 80 to 90 cents back for every dollar you put in, not a full dollar. Break even takes 3 to 5 years to hit. And does that sound familiar? It should, because your house does this too. The day after closing, you're underwater thanks to closing costs and fees eating into whatever you just paid. Sell that house in a year or two, you'll lose money on this deal. Nobody calls a house a scam because of that. So here's the actual red flag you should watch out for. If a policy shows zero cash value in years 2 or 3, that's not the product being slow. That's a policy set up death benefit focused, not cash value growth focused. And that's a different animal from what we're talking about here. So here's the truth. You were never getting 2 stacks of cash sitting next to each other. You get the bigger number and the cash value was built into it the whole time, exactly like equity in your house. Proper design is its own conversation because not every policy out there is built the way we just talked through. I break down how policy loans actually work in the next video, so watch that one next, or book a call and I'll run your own numbers.